Hello guys, welcome to the money supply, money demand part 2 training again. So previously we have discussed guys the supply and the demand for the goods and services, and this part in part 2 we're going to go to discuss the money supply and money demand curves, and we will see how it works. So let's go into it. So first thing I want you to understand guys, what does the basket mean? So basket means a group of goods and services required by a household. So we discussed that the household is a group of people living under one house or one shelter. So those group of people, they require goods and services, and their identical goods and services, we call it basket. So the basket is containing different goods and services, and the central banks now, he measure the consumer price index based on the price of the basket. So the central bank, he can measure how many dollars required to purchase one basket, or how many basket he can purchase in 1 unit of dollar. So this is what does the basket mean, and later on in this video I'll show you how the basket look like. So now let's discuss the money supply and the money demand curves. So first of all, previously we were identifying this axis as a price axis. Now, however, we're gonna go to say that this is the value of the money axis. Then we have the money quantity axis, and this is well identified, the money quantity required for a certain prices. And let's put some values here, and let's put on the other side here the price of the basket. So we're gonna go to measure the basket price. So let's say this is the prices for the basket, and let's say this is the money supply curve, and it's a vertical line. Don't worry, think that this is the money supply curve. I know the money supply has to be like this, but however, we call this elastic money supply curve, but I don't want you to think about it. Later on, we'll explain what does elasticity mean. So let's say this is money supply 1, and let's say that now this is the money demand curve. So let's think now the value of the money when the price of the basket at $2. So now the basket is fixed, doesn't change. Okay, so the basket is containing goods and services, and the basket fixed, it doesn't change. So on daily basis, you are going to the market, you are purchasing food, services, whatever. Those food and services which you are purchasing as a consumer, it doesn't change. However, the only thing changed is the prices for those goods and services. So let's say that the price for this basket was $2. So at $2 price, when the money supply was at money supply 1, the value of the dollar was halfway. So let's say that the central bank will determine the value and the money in the market, and he wants to supply more money to the market. So what is going to happen now? If the central bank, he see that there is no consumption in the market, and he's not happy with the consumption because he's measuring the inflation, and he want to maintain the inflation target 2%. So if he see that the inflation is below target, he gonna go to supply more money. Then this money supply will shift to the money supply 2. And when we say money supply 1, money supply 2, we doesn't mean M0 in 1 in 2. That is different. That is the type of money. Here we are talking about the supply curve. So money supply 1, money supply 2 is representing the money supply shift to the right or to the left. So money supply 2 is shifted to the right. Then we have now more money in the market. We have pumped more money in the market. And how we can pump more money in the market? We said through open market operations, like buying bond, treasuries, and buying government assets. So we pump money into the market, and those money will go to the banks. End of the day will go to the banks, and those banks will have checkable account, and checkable account will be lended to somebody, and that somebody he will deposit in another bank, and so on. So we discussed this in the previous part 1 video, and this is a continuation for it. So now money supply is increased. The market now is having more money. There is a more competition in the market. So people, they are willing more. So now these people holding the baskets, they're going to go to start increase their prices. So the price will reach $4. And at $4 price, when the demand with the supply to crossing, we have the optimum area P. And at that point, we have the value of dollar going to the quarter. So the value of the money now dropping to the quarter. So let's take the same chart and discuss now what is going to happen if we shift the money demand to the right. Let's say that the price for the basket was at $4 and the money value was quarter. So let's say now the prices increase. Now you need more money, more units of money to purchase, because let's say if you have a house and that house was $10,000 price, now the people is having $10,000. Because there is a demand on the house, you're gonna go to sell this house for $10,000. If the money finished from the market, that means that the house is $10,000 price, but you have less money, so you don't have power to purchase. So economy will go down. So what the central bank will do, he will pump money. When he pump money, so people, they will have more money. Let's say now the guy who is having, let's say $10,000, he becoming having, end up having $20,000. So $20,000, he's having more money, but the house doesn't change. It's still the same house. We did not duplicate the houses. The productivity of the house is still the same. Now, these people, owner of the house, they will increase the price of the house. So now you will end up by having that price for the house, $20,000. So you see, you have duplicated the money, but the house is still the same. It's the same product. So you end up by giving the $20,000 to buy that house. And this is what we meant by having a demand for the money. So if the price is at the highest level, you need more quantity of money to have more purchasing power. So what is going to happen if the money demand shift to the right? If the money demand shift to the right, then the people which they are holding the basket, so these people, they will see that there is nobody at the beginning having money, purchase power to buy the basket. So there will be more demand on the money. So if they want money, what they gonna go to do to have the money? So they're gonna go to start to decrease the prices in order to sell their product, sell the basket, and get the money, because there is a demand for the money. So what the central bank will do in this case, he will increase the interest rate, or he will sell the government bond, the one he purchased in the beginning, and he will pull the money from the market. When he pull the money from the market, these people also, they need money. They will start to decrease their prices. When they decrease their prices, the money value will go up now. Now, coming back to the same example of the house. If I have house, the price is $20,000, and there is nobody's having that price, nobody's willing to pay that amount, they doesn't have money. Now the house owner, he demands money, he require money. Now he want to reduce the house price in order to attract people to purchase that house. So now you can realize that you're gonna go to pay less quantity of money to hold that house. So let's say that the house is reduced again from $20,000 to $10,000. That means the value of the money now started to increase. So when the demand on the money goes up, the prices will go down for the basket, and the value of the money will go up. All right, so you can see that the value at B is increased, doubled, and the price has decreased. So now, what to take from this slide? So if the prices of the basket increased, you need more money. So that is a shortage of money. So means money demand. So printing money will decrease the value of money. So printing money and pumping money to the market will decrease the value of money because you will have the same products, the same basket, and later on, now I'll explain what does the basket mean. The same basket, the same product, the same services. However, the money increased. So if you print money and if you pump more money in the market, you're gonna go to end up by decreasing the value of the money. The CB will measure the basket quantity per dollar or vice versa, how many basket I can purchase by $1. If the central bank increase or decrease the money supply, then the value of money will be changed. So now let's look and see how does the basket look like. So this is the basket. So this is the CBI, and the CPI is the consumer price index, and this is how we measure inflation, and this is the basket. And you can see here that the government, they are measuring the prices for certain goods and services, and we call this as a basket, and this measurement is based on the base year, and later on we'll discuss this in different video when we discuss this indicator by itself. However, I want to show you the basket content and how it looks like. So the basket is having food prices, meat prices, that is included in the food. They have also fruit prices. They have also food away from home. They have energy prices. They have footwear prices, transportation and commodities, medical care and commodities, educational and commodities, alcoholic and beverage, and so on. So you can see that this basket is containing so many services and so many goods. And all the goods and services including in this list, we call them the basket. So the government or the central bank, they measure several goods and services required by a human or household. And we say that the household is a group of people living under one shelter or one house. So they identify what is the goods and services required by those people, and they measure the prices for those goods and services, and they name these as a basket. And this is how the basket look like. Later on, we will explain this in detail in the future videos. Now, I want to come back to the same chart, and I want to discuss the basket, and I want to take an example for the basket. So now I want to discuss with you an example about how we can measure basket and how we can think about basket. So let's say we know that now the basket is not containing a single product or a single service. It's multiple services, multiple products included in one basket, and that basket required for the household, for the lifestyle. And the government is measuring that basket price and measuring inflation based on that goods and services prices. So let's now take example on 10 ice cream pieces, and let's think that this is the basket. Okay, the 10 ice cream pieces are the basket. So we take simple example. So let's say the price for the basket, the 10 ice cream pieces, is $2. So it was $2 when the money supply was at money supply 1. And when we say money supply 1, money supply 2, here we mean to say the amount of money in the market. We are not referring to the M0, M1, M2, the one we have discussed in the previous video. That is the type of money available in the market, whether it's a printed money or money with checkable account or money in total with saving account. That is the type of money. Here we are measuring the money supply curve. We say money supply curve 1, money supply curve 2. So this is the shift on the money supply when we increase or decrease money. So when the basket was at $2 in the money supply 1 at $2, the value of the money was halfway. Then when we shifted the money supply to the right, so the optimum price change, P, the price is increased to 4 for the basket, then the money value decreased because now I have more money quantity in the market, but the basket is still the same. It's 10 pieces of ice cream, so it doesn't change. So now the money value was half. When we shifted the supply of money, the money value became a quarter. So now, one basket equal to 10 ice cream pieces, and that doesn't change when we have shifted the money. Still the productivity is the same. It didn't change, so we have had only 10 ice cream pieces. The total 10 pieces, that is the basket price, was $2. And when we have shifted the money supply, it became $4 because the prices has increased, because the value of the money decreased as well. So now let's think these from money point of view. Let's say that I am going to buy euro and I want to purchase that by dollar. So let's say that the price, we are using the same chart. Let's say that the price for €1 equal to $2. So the price, when we have had money supply 1 at the price 2, the money value for the dollar was half, and the total price for €10 was $20 because each euro equal to $2. So we needed $20 to purchase €10. So let's see what is going to happen if we shift the money supply to the right. So the price of €1 now equal to $4, and the money value decreased to the quarter, and the price for this $10 now become $40. So of course, guys, these are not real number, but I'm putting big numbers so you can understand what is going to happen when we are printing more money. So let's think now from currency point of view, how does the interest rate affecting these currency prices? So in the interest rate, there is a formula, and that formula will give you the value of the money comparatively. So let's say that the value and the dollar increase together. So both of them, they are increasing the interest rate. So the value of the two currencies will go up. So how we can distinguish which value of currency better than the other currency? We can do that by having this formula, by dividing the interest rate of the base currency by the interest rate of the counter currency. So there is a formula to do that, and there is a formula to measure the change of the value of that money. So that will give us a hint how to trade the currencies and how to trade the gold as well. So the formula is, it is 1 plus the interest rate of the base currency divided by 1 plus the interest rate of the counter currency. So now this is a real numbers here. This is the interest rate for the euro, and this is the interest rate for the dollar. So 1 plus the interest rate of the euro is equal 1.25 euro divided by 1 plus 0.250 US dollar, and the result of this calculation here will be €90 for each dollar. So you can see here, I'm going to give 90 euro to have $1. So that means here the value of the euro is more than the value of the dollar. So the value of the euro, you're going to go to pay less euro to have $1. However, to trade on these and to understand how it's affecting the market, you need to see the previous calculation of the euro USD dollar and compare it with this current calculation and see the change, whether it is negative or positive for one of those currencies. Okay, so if the value is positive for the US dollar, we buy US dollar. If the value is positive for the euro, we buy euro, and vice versa. Now let's discuss the central bank tools and the central bank indicators. So the central bank, we said that he's gonna go to have indicators, and those indicators will be used for measuring the economy, and he will be having tools, and those tools will be used to react on the result of the indicators. So the indicators are divided into two types of indicators. So the first type is lagging indicators, and the second type is leading indicators. So the lagging indicators are the GDP, the gross domestic product, the CPI consumer price index, the unemployment, and the income. And in the future videos, we're going to go to discuss each indicator in details separately. So leading indicator, you have the household permits, because if you have a permits now, that is an indication for the future sale for houses and building the houses in the future. So that is a leading indicator because it tells us something about the future. House sales also, it's an indication for the health of the economy, whether you have increased or decreased the value of money. You're gonna go to measure house sales as the health for the economy. So money supply, money demand as well, it's a leading indicator because money supply today will tell us what is going to happen in the future, whether the prices will go up or down. Stock market also, because that is the area where we're going to go to identify whether the central bank has started to do the open market operations by buying government bonds and doing some operation on the stock markets. If you see the stock markets going up, that means there are so many purchases. If you could see the stock market is going down, that means there are so many sell. Import and export also, because we're going to go to measure the partner countries. If, for example, I am a country purchasing from China, so I depend on China's product. So if something happened to the economy of China, is going to affect me because I am importing from China. So prices there is affecting my prices as well. So this is how you're going to go to measure export and import. If I am exporting to some other countries also, my prices were going to go to affect that country prices. So it's having a relation. So the tools of the central banks, and this is the things that the central banks, they're going to go to use to react on those indicators. So the first tool is the interest rate. They're going to go to hike or decrease the interest rate. So when they hike the interest rate, they increase the value of the money. When they decrease the interest rate, they reduce the value of money. Money supply, money demand also. So we understood from this video that when they increase the money supply, the prices of the products and services will go up and the money value will go down. And the intervention of the central bank in the stock market, they're going to go to buy or sell asset and treasuries and government bonds. So now we are coming what we need to take from this training. So first of all, we need to understand on which indicator the central bank is focusing and how the central bank is responding to these indicator result. So for us, for trading goals, we are focusing on the US market and we are focusing on the inflation of the US because the central bank are focusing on the inflation. So we need to see if the result is responding to the action taken by the central bank. So the central bank, we're gonna go to use the tool and will produce actions. And we need to see that the indicator result is responding to those actions. We need to monitor also the leading indicator result. And that is the measurement of the stability of the economy. Now, let me clarify something. When you say lagging indicator, that means indicator is depending on the data history. When you say leading indicator, that means indicator telling you what is going to happen in the future. So for us, we focus on the leading indicator because it tells us what is going to happen in the future. However, we focus on the lagging indicator because those indicators will tell us what are the expected actions going to happen by the central bank, and based on that, we can anticipate. So for example, if the consumer price index is going up, central bank will raise interest rates. So we start to buy dollar. So we start to think automatically that the value of the dollar will go up when the central bank increase the interest rate. So now I want to discuss the concept of buy the rumor and sell the fact. So I have a small example here and I made it simple. So guess that the central bank today announced that he is going to raise the interest rate after 1 month. So we are now anticipating that the value of the US dollar will be increasing because the central bank gonna go to raise the interest rate in the future. So now, based on this rumor and based on this announcement, we call it rumor, we started to purchase dollar. Why? Because we think that after 1 month, the price will increase because the interest rate will be raised up. So this is a rumor. Now we are buying based on our anticipation. So this is what we call buy the rumor. Now sell the fact means we bought the US dollar and we reached that time where the central bank started to raise the interest rate. Now, by that time, all the people, they based on the rumor, they have bought the currency and they have reached the maximum level of that price. So when they have increased the interest rate, the price fell down because we are selling the fact now. So this is what we have meant by buy the rumor and sell the fact. Announcement came for the interest rate hike we anticipated. Based on our anticipation, we have bought the currency. After buying the currency, the interest rate was raised up. When they have raised up, already everybody has bought the currency and reached the maximum level. Then when they have raised the interest rate, the prices goes down because that is the sell of the fact. So now the factors affecting the gold price and the dollar. So first of all, we need to focus on the interest rate because the more the value US dollar is having, the gold value will go down and vice versa. So first of all, we focus on that one. And again, focus on the interest rate. It doesn't mean that we need to wait until the interest rate raised up or reduced down. We need to anticipate that from the inflation and from the leading and lagging indicator, which we're gonna go to explain them in the future videos. Then we need to focus on the DAX. The DAX mean is the dollar index. That is the measurement of the dollar index against a basket of currency. So the DAX is having a chart. So we can analyze that also technically. So we can see whether the DAX is support level or at the resistance level, and we can measure and draw technically that price and anticipate whether the DAX is going down or the DAX is going up. We can focus also on the economy of the partner countries, and as we discussed before, that is related to import and export. If you are exporting, you need to know the prices affecting other country prices. If you are importing, that you need to know the prices in the country you are importing from is affecting your prices as well. So we need to focus on that one, and we will discuss this in separate video later on. Gold prices raises in the risk off, and we will discuss risk off, risk on strategy in the future videos as well. Finally, I hope that this video was useful for you. We have covered money supply and money demand in the previous video, part 1, and this video, part 2. If you like this training, please subscribe to our channels on YouTube and Telegram. Thank you very much, and see you in next training video.